So recently I helped a client eliminate $20,000 in credit card debt in 5 months, and he's on pace to eliminate $40,000 in 12. Want to know how we did it? Well, keep watching. See, this applies to those of you trying to qualify for some bank-related product like a mortgage, or you're having any purchase transaction problems related to any recent home purchase opportunities. See, now is the time to leverage any retirement dollars such as an IRA, a 401k, a TSP, or a 403b during this pandemic to become more financially stable. And I know, why would I even want to do that? How could that possibly be a good thing? Just follow along. Now, this may not be a reasonable option for everyone because this requires a level of focus on your personal finances and a hunger to do better than maybe you currently are today. So I want to share with you an exchange that I had with my client. I had a client reach out for consultation and my personal opinion as to whether or not it was a good idea to use a self-directed retirement account to eliminate $40,000 in credit card debt. So let's take a look at what $40,000 in credit card debt actually looks like over time. Paying 24.9% interest on $40,000 is costing him close to $10,000 per year. And paying the minimum balance every month is virtually impossible for him to ever get out from under this debt. And even if it only took him a third of that 30-year illustration that I showed, that $40,000 of credit card debt would still be costing him closer to $138,000. In my opinion, the only justification you could possibly make to not take some type of drastic measure, like using your retirement dollars to pay off $40,000 in credit card debt, would be if you had some type of comparable investment where that $40,000 was bringing you 25% or more return on your investment. Now, while those types of investments do exist, the likelihood of you being in a position to take advantage of it is very slim. And for those of you working with those credit repair companies trying to consolidate or eliminate debt, now is the time to reduce or eliminate debts such as high interest rate credit cards or high interest car loans using your qualified pension plan such as a 401k. And to further lay this out, take this into consideration. As of this taping, the stock market has hit a record high. We are headed into the presidential election. There's a severe amount of uncertainty as a result. So would it make sense to use some of those stock market gains to eliminate debt? And as it specifically relates to my client, eliminate debt that's costing him $10,000 a year. So today I would like to review a client who's focused on credit repair while reducing debt. Their original focus was to take control over their previous employer's retirement account, and they were able to do this once I created for them a checkbook-controlled, self-directed 401k. This allowed him to transfer $100,000 from his previous employer's plan, which he is now using to invest in real estate. See, he's a part of this pretty strong community that I work with extensively. As a part of his growth in education, he is learning velocity banking and the impact that it's having on not only his credit, but his ability to reduce debt. So what is velocity banking? Velocity banking is a concept of positioning a home equity line of credit, a HELOC, or a personal line of credit, a PLOC, or in some cases a credit card as a debt tool. A debt tool such that it is used as your primary account where you will deposit your monthly income into that debt tool, and any expenses to be paid will be paid out of that debt tool, and any cash flow left over will actually live in that debt tool. There are pros and cons to each debt tool and how you use it to eliminate debt or increase cash flow. Regardless of the one you use, if you are focused and the tool is used properly within the velocity banking concept, this could change your financial trajectory. While I'm not a velocity banking guru like the ones I know or the ones I follow, I am a veteran of its use. And I have my own testimonials how velocity banking took me from a 509 credit score to over 740 in less than a year. And if I'm being honest, it was really just over 6 months. As well as I continue to use velocity banking to this day. So here's my attempt at explaining velocity banking and making it simple. My client reached out to me and stated he has $40,000 in credit card debt and wanted to know if he could use a portion of his self-directed retirement account as a debt tool for velocity banking. And if so, what's that process? The short answer to that question is yes. And as a result of the CARES Act and the fact that he has a qualified pension plan with his current employer, and I created for him a self-directed checkbook control 401k, he has the ability to take a distribution. So whether he wanted to take a distribution from that qualified pension plan like a 401k, a TSP, or a 403b, or if he wanted to take a distribution from his self-directed 401k, he could. And in addition, he would also be able to take a loan from his qualified pension plan with his current employer or a loan from his self-directed 401k. He has many options available to him. The question is, which one should he use? Well, I told him the same thing I would tell you. What does the math say? My client had a few requests. He doesn't want any tax implications, and he also doesn't want to be placed in a position where he would have to be forced to pay back the entire lump sum at any point. So in that case, he does not want a distribution. He would prefer a loan, And he understands that having a loan against his 401k means any interest that he pays, he would be paying back to himself. So the question I ask is, what would the interest rate be for a loan coming from your qualified pension plan with your employer compared to a loan coming from your own self-directed 401k? What's the difference? The maximum loan amount that he was able to get from his employer-based plan is $20,000. Why only $20,000, even under the CARES Act? It's because that's what they decided to provide to him. The interest rate they are charging him on that $20,000 is 8.67%. Well, why did they choose 8.67%? Because they can. It's the employer-based plan. They can do whatever they want to. Well, with his self-directed 401k, which he transferred $100,000 from a previous employer's plan into, so he has $100,000 available to him in his current self-directed checkbook control 401k. The interest rate that he is allowed to choose to charge himself is prime plus 1 or 2%. So as long as he follows those guidelines, he can take a loan. And he can take a loan for 100% of what's in his self-directed retirement account up to $100,000. And the interest rate that my client chose to charge himself was prime plus 1.25%. Well, if prime is 3.25 and he charges prime plus 1.25, he's charging himself 4.5% on a loan of $100,000 if he wants, compared to his employer's offer of $20,000 at 8.67%. Which one is a better offer? So my client decided to use his own self-directed retirement account to get himself out of this debt. And he agreed with the $20,000. So instead of taking the full $40,000 that he needed to wipe out the debt, he chose to only take $20,000. And here's why. The remaining $80,000 that he had in the self-directed retirement account was already committed to a real estate investment. He's got 20 grand left over. He's going to take 20 grand and use that 20 grand as an accelerator on his debt tool to be able to pay off $40,000 in debt. So my client asked me if I could map out what that looks like. How could he use $20,000 as an accelerator with a velocity banking debt tool to eliminate $40,000? Okay, so I did it. And I thought it would be cool if I shared with you what those steps look like. Why? Because this applies to everyone. Now, your financial situation may not be the same. You may not even have access to the type of dollars that he has, but that doesn't matter. The point is the concept is there, and how you use the concept could change your financial landscape. I thought it would be cool to show you how simple and efficient velocity banking is while using your retirement dollars to accelerate the payoff of debt. So here we go. And as mentioned, I like to follow the math. $40,000 in credit card debt at 24.9% interest, only paying the minimums and having no real plan to address, could ultimately result in him paying close to $400,000 for this debt. And yes, that's 24.9% interest that he's paying on $40,000 in credit card debt. But my question to you is, how many of you are paying a comparable interest rate on some credit cards and still sitting there wondering why you're not making a dent in that balance? Could you be going through something similar? So next, I'll share with you his numbers. One of the keys to velocity banking is understanding your numbers. Do you understand your numbers? What do I mean by numbers? See, it's hard to know where you're going if you don't understand where you are. So income, how much money do you bring in every month? That's the first number. Expenses, how much money goes out every month? How much are you paying in bills every month? What is your total debt? And what I mean by that is, how much do you owe on your home? How much do you owe on your cars? In total, how much do you owe in credit card debt, your student loans, your medical bills? When you add all that up, what is your total debt? Do you know your total debt? And the most important piece to this puzzle is, what's your cash flow? When your income comes in and those expenses go out, what's left over? What's left over is your cash flow. Do you know your numbers? You should. And I'll let you in on something that I find quite interesting after working with such a diverse clientele. Most people, as it relates to cash flow, most people have somewhere between $0 and $1,000 per month. So whether you make $250,000 a year and whether you make $50,000 or less, 9 times out of 10, your expenses match that income, and what's left over is somewhere between $0 and $1,000 a month. So the bottom line here is, just because you make more money doesn't necessarily mean you know how to manage it. See, you may make 5 times more than me, but I may have more cash flow than you. And my goal is to share with you the tools to change your financial picture. So my client's numbers: income is $6,000 a month. His expenses are around $5,000 a month. His total debt is right around $300,000. And of that total debt, $225,000 of that is his mortgage. The remaining $75,000, of that $40,000 is that credit card debt that we're going after. And the remaining $35,000 is 3 vehicles that he's currently paying on. So his cash flow, and if you remember, income is $6,000, expenses are $5,000. His cash flow is anywhere from $500 to $1,000 a month. Now, the reason it's not always $1,000 is things come up. Sometimes a car needs to be fixed, or I want to go out to eat a little bit more often, or maybe I went to the casino. But the bottom line is cash flow is somewhere between $500 and $1,000 a month. And remember, he's taking a $20,000 loan from his self-directed 401k. He's got $40,000 in credit card debt using a $20,000 loan from his self-directed 401k. And don't forget, he's got to pay that loan off too. The $5,000 monthly expense breakdown goes like this. About $1,500 of that is for his mortgage. Of that $5,000, $1,450 of that is for other expenses such as phone, cable, HOA, utilities, and things of that nature. $1,250 a month is for 3 vehicles that he's paying on. And the remaining $800 a month is being split between 7 credit cards. He's taking $10,000 of his $20,000 loan and putting it on 1 credit card. That 1 credit card has a $20,000 limit and it's maxed out. So if he takes $10,000 of his 401k loan, puts it on the 1 credit card that's maxed out at $20,000, it immediately drops that balance down to $10,000. So he's got 1 card that he's now dropped the balance down to $10,000. The remaining $10,000 from his 401k loan is now being spread across the remaining 6 credit cards. And in doing so, that allows him to pay off 3 of those credit cards. So out of the 7 credit cards he has, this $20,000 influx of cash has allowed him to pay off 3 of those 4 credit cards. And the largest one, which was maxed out at $20,000, he's been able to pay in half. So to map out velocity banking, for those of you who might be hearing this for the first time, the process looks like this. So income comes into your checking account. You then transfer that income into your debt tool. All bills are then paid from that debt tool. Any cash flow that's left over, once all of those bills are paid, now lives as principal on that debt tool. And then next month, you do it all again. Income comes into your checking account. You transfer that income into your debt tool. All bills are then paid from your debt tool. Any cash flow left over lives as principal on that debt tool. Then you do it all again and watch the magic. As you're doing that, the cash flow that's left over on that debt tool, the principal that's left over, is now reducing the original balance that you had on that debt tool. I know this is a lot of words, but keep following. As far as a debt tool, my client decided to use the $20,000 credit card that we had placed that $10,000 influx of cash on, which drops the balance down to $10,000. He decided to use that as his debt tool. After about 5 months of $6,000 in income going into the credit card and $5,000 in expenses coming out, that balance would be paid off. And I believe my client is currently entering the 5th month. So once that balance is paid off, he's going to have to find more debt to pay. So what do you do? So if you remember, he still has 3 remaining credit cards that still have a balance in total of about $10,000. So what he would do is do a balance transfer from those 3 credit cards onto his debt tool. So follow the exact same process of income going into the debt tool, expenses coming out of the debt tool, and the cash flow staying on the debt tool. And in doing so, it will take another 7 months to pay that additional $10,000 debt off. Overall, in 12 months, my client would have paid off $40,000 in credit card debt using a $20,000 loan from a self-directed 401k to accelerate that payoff. And he would have increased his cash flow from $1,000 a month up to almost $1,500 a month. And just step back and imagine those original 5 months. The 5 months of paying down that first credit card with the $20,000 maxed out limit. What did paying off that credit card do to his credit score? What did paying off that credit card do to his credit utilization? How did it impact his DTI? How did it impact any purchase transaction problems he might have been having? That could be you. Not to mention that $20,000 loan from his self-directed 401k that he used to accelerate the payoff. That loan does not affect his credit. That loan does not show up in his DTI. And no, I don't have him making any extra money. I don't have him getting any raises. There isn't any bonus. There isn't any income tax check that he's allowed to apply to this. This is if he made no more money at all This is how long it would take for him to pay off $40,000 in credit card debt. It's pretty amazing. His lifestyle hasn't changed at all, just his perspective, just his focus on eliminating debt. At the end of the 12 months, what's left? Now it's time to tackle the 3 cars, the mortgage, the 401k loan. All in all, in about 5 to 7 years, he could eliminate debt by following the velocity banking concept and not making any more money. Debt-free in 7 years. I'm not suggesting he would want to be debt-free in 7 years. My point to you is the possibility is there. By following the velocity banking concept, he could be debt-free in 5 to 7 years. So what was actually required of my client? What would actually be required of you? What was actually required of my client in this moment is discipline, focus. That's all. And that would be the same requirement for you. While your situation may be different, while you may not have a 401k to be able to take an influx of cash to be able to accelerate the payoff, you do have the ability to decide. You do have the ability to focus. You do have the ability to change your perspective and use this concept to pay off debt. I guarantee you could have the exact same results using this process, regardless of your income level. The key is you deciding to be disciplined and staying the course. Hey, Courtland, what does deciding mean again?
Zoom in close on the word decide. Look at it closely and notice the similarities that it has to words like genocide, fungicide, pesticide, suicide, homicide, genocide, right? All of them have this word side at the end, which comes from a Latin term meaning to kill off, to exterminate, to destroy. One of the reasons why decisions can be so hard sometimes is because it literally means a death to all other alternatives. When you truly decide, you are killing off all other alternatives. When you make a decision at that level, when you killed off all the other alternatives, then watch what happens. Watch how providence begins to move on your behalf, because at that place, you have truly committed. Sometimes the ideas and the inspiration don't come to us because we haven't truly decided on anything. Sometimes that brilliant solution isn't being made available because we haven't decided on anything. You want to get moving in your life? Decide on something and watch how ideas and solutions begin to flow. Determine that there are no back doors, no other alternatives, no options left on the table, that you will have this outcome, this dream, and it's a non-negotiable. And watch how you begin to flourish. Simply decide.
You should also note, I left a lot of information out, and I left it out intentionally. See, I will transition this example into another example where I will give you the specific details as to how he was able to eliminate $40,000 in debt within 12 months. If you want to better understand those steps, if you want to see those steps on paper, follow me over here to this next video. This next video will also prove just how simple and efficient velocity banking really is and how it can truly change your financial well-being. I'm Donnell, and this is Self-Directed Investment Strategies. And for those of you who want more of this example, I will see you momentarily. Don't forget to like, subscribe, and share. So until next time.